Well, hello, Maverick traders. Welcome out to your market roundup for July 21st. Corey Halliday here with you. As always, we start with a reminder to make sure that you follow your trading plan. So let's get into the markets here a little bit. Kind of an interesting couple of weeks for the markets as we've been correcting to the upside. Today was a little bit of a mixed bag. Russell 2000 actually was the laggard, as was the Dow. The S&P and especially the Nasdaq kind of led to the upside. Oil down sharply. There was a big supply build, some nervousness about increases in production and so forth. But I've been of the thought process here. I kind of talked about this over the past couple of weeks, that big flush out to the downside, and it happened. And now I think oil stays relatively well bid. So anything in the 80s, 90s, 100s, and my guess is that we're going to head back up there to 110, 120 is pretty strong for energy companies. Gold, a little bit of a bounce back today, but what a disaster precious metals have been. The US dollar broke out of a multi-year uh, consolidation, and if there's anything that gets hurt by that, it's gold and silver as kind of an alternative currency. They have certainly suffered here over the short term. As we look at the advanced decline line, about half and half advancers and decliners today, a little bit more on the advancing side. And then look at the 50-day moving average. We've now got more than half of stocks above the 50, and that's what a correction can do. So the big debate right now is, well, is this just, we've reversed, the bottom's in, and we go up, up, and away? Or do we have another, this is kind of a correction that probably has a little bit more to go, but then we go back down to the downside. And I'll give you my take here in a bit. On the daily news, President Biden tests positive for COVID-19. Symptoms are said to be pretty lackluster, nothing too dangerous right now. And the ECB hikes rates for the first time in 11 years. Now, let that sink in a little bit. The first time in 11 years that they've hiked rates. They were at a zero interest rate policy. Expectation was for a 25 basis point hike, and they went 50. So a little bit bigger rate hike than expected. And you're now seeing that, and it's part of the US dollar. The US dollar has had such a run versus every other currency that these countries are now kind of competing with each other and raising rates to stabilize their own currency. So it's created some ripple effects, some things that could be negative, and so they're trying to combat that. Let's look at a few charts here. We'll start with the S&P. So we've talked about this. I mean, I've certainly been a bull. This was an important level when the market came down here. I said, look, you're in one of two camps. Either it's down, down, or we get this corrective phase. And I still think we're kind of in that corrective phase. Now, there should be, could be, would be a little bit more to go here. But as you start to fill this gap and start to get up a little higher, I mean, boy, the risk to reward to me just doesn't look great aggressively buying here. I think as a buyer, sentiment was down in the dumps, and if you were buying on some of these dips, that was the place to do it. And I had a very, very bullish posture back there. I have flattened that out a little bit here today specifically on this advance, and I'll probably lighten up a little bit more into a little bit more advance here and get probably neutral on the trading side. Half bulls, half bears. And I've been very bullish. I've been positioned with far more bulls than bears. I just felt like this was the first time in a long time where it favored that. So I made mention, I was fully in the camp that we were in a corrective phase. And part of that was, kind of what was known and what was unknown. There were a lot of unknowns that hit the market, right? Some things that weren't planned for earlier this year. Russia invading Ukraine. Most people didn't see that coming. I don't think anybody had that as a forecast on Wall Street or anything that way. Oil prices, we probably saw them going up, and they kind of spiked pretty dramatically. Oil year to date has been by far and away the best performing sector. That hurts the economy. Inflation running rampant. Rate hikes. The expectations coming into this year we're for a little bit on the rate hiking cycle. Remember the transitory inflation outlook, and markets had to adjust dramatically to huge interest rate hikes around the world. My point is that those unknowns have been known now, all of them, for multiple months. The market has had ample opportunity to price in all those bad news events. So the question is, well, at this point, or back here rather, is it priced in? Does it now favor trading to the upside? And I felt it did. Other aspects of that, if you look at consumer confidence at 50-year lows, I mean, there were just so many things where people were in the bunker, nervous, felt like the world was coming to an end. It was anecdotal, but I referenced this conversation I had with my sister-in-law where she was just saying, "Oh, the world is such a bad place, and it's just so terrible, and inflation." And I said, hold on a second. I know everybody, this is what we call cocktail talk, but everybody's pessimistic and everybody feels the way you do. But what period of time in history would you like to go back to? Do you want to go back to the 80s? Do you want to go back to the 60s, the 40s, the 20s? You want to go back a couple hundred years, horse and buggy and so forth. Where do you want to live? Medicine, better than ever before. I mean, entertainment, quality of food and of life and everything. I mean, we can do so many things, and I realize that it's not great for everyone and their struggles, and I get it, but we've made a lot of progress, and I think that continues. So I kind of talked about that over these past couple of weeks. I get it, it's cocktail talk, but I think that was the sentiment around the world. The Qs, nice breakout out of a little bit of a downtrend line here, a little bit of a symmetrical triangle that broke out a few days ago, and we've ramped. Now, we've already gone a long ways in a short period of time. I don't love buying breakouts when you have all this overhead supply. That seems like a recipe for disaster. I compare that to Michael Jordan trying to jump from the free throw line, which is what a breakout is. If you're buying here, you're saying, well, I think it's just going to keep surging. Well, it's Michael Jordan trying to jump from the free throw line and dunk it, but he's got these weights on his shoulders. And you start stacking up a lot of weight. This is dead weight. These are people that bought at bad prices. They want their money back. That's a lot of supply, a lot of potential sellers. So I'm not chasing to buy breakouts here. I'm more lightening up on the buy side as opposed to aggressively buying in here. As we look at the heat map, energy sharply in the red. We talked about oil down today. Natural gas kind of flat-ish. Down move in telecom. AT&T's results are hitting Verizon, hitting T-Mobile, telecom getting hit a bit. Tesla sharply in the green on some better than expected earnings, I guess you'd say. It was a little bit of a mixed picture there. As we look at healthcare, healthcare has been a little bit disappointing this week. Really pretty flat. Or if you look at XLV, the healthcare chart, it's flat while the market's gone higher. And I have, that's an area of frustration for me because I've kind of spun my wheels in healthcare instead of making money. And I had some longs there. So that happens, but I had some other longs in other areas that did really well. That one, I have to say, was a little bit of a disappointment here in the short term. Now, in terms of our weekly and monthly outlook, things have changed, right? We're now above the 20, we're above the 50. The slope is, I'd call it neutral. The 50's kind of flattening out, the 20's trying to curve upward. On a monthly basis, I think you'd have to kind of be shifting more towards neutral as well, just given the price action. But again, the debate of whether this is really the bottom and so forth, I'm not so sure it is. I think this is kind of how markets work. They tend to try to frustrate. People got too negative, too pessimistic, too bearish, and this is the pain, right? They're seeking max pain. It probably has a little more to go. Some stop outs. If the market were to spike, if you were to see kind of an exhaustive type of move where it's a big ramp higher aggressively, um, expanded range candle where the candle's much larger than normal and so on, I would see that as somewhat of a kind of a finishing move, kind of putting an exclamation point at the end of this sentence, at the end of this move. So we'll be watching for exhaustions. Let's talk about some bulls, neutrals, and bears. On the bull side, I'm going to focus on one industry specifically, and that's the video games. Now, compared to the S&P, far closer to its highs. That's one good thing. It is trying to break out, and I'm not so much inclined to buy the breakout necessarily as thinking that we are going. This is kind of an inverse of the symmetrical. This is an alligator pattern where you actually made new lows and then immediately went to make new highs. Do you see that? Where it had been in a downtrend and this is now higher than the prior pivot high after a lower low. Now I think we'll get a little pullback here and that 20 will curl underneath, and that's where I would look to buy. I'm going to be a buyer of the next dip. That's EA, that's in the video game space. EQT, which is the largest nat gas producer in the US, natural gas has held up better than oil, and I think that continues. And I'm going to put this in the exact same category as EA, where again, most of my buys here in the short term are going to be on dips more so than chasing momentum. But see the alligator, see how we went from new lows to immediately new highs above the high. I'm not chasing the breakout, but as you pull back for a couple of days, this 20 is curling up underneath. I'm going to look to be a buyer of the next dip. And so I'm trying to find things that I want to buy, but I'm looking at them as a dip buying opportunity. Last but not least, Take-Two Interactive. I touched on the fact that, video game producers, well, this is like EA in that way. We're kind of coming up to resistance. What I'd like to see is, again, a little pullback, a curling up underneath of those moving averages, and I'm inclined to be a buyer of the next dip. It'll be a little mini cup and handle type of dynamics, something along those lines. But on the dip, I I would like to be a buyer on Take-Two. Now, I've had Intel on the sideways trade for some time, and it's been really sideways. I mean, it depends on where you put this on. We've talked about it a few times over the past few weeks. If by chance you put it on and your sideways range that you're expecting it to be in is like 39, it's possible it's 40, in which case I'd probably take profits. If your target is a little lower, I'd be inclined to stay in because I think it's still coming back in a little bit here. So say you built your sideways trade where 39 was your target, maybe even 38, I'd be inclined to stay in. But as you get that dip back to 39, 38, that area of 39-ish, I think I would take profits on the neutral trade, and we'll probably remove that from the neutral ideas list going forward. On the bearish side, so Honeywell has advanced, but here I think is a situation where it's underperforming, and really I suspect that it's going to remain kind of in this consolidative mode and maybe build a best case for it, where it kind of goes sideways and back and forth. I see this 180-ish level as being kind of the upper end of the range, and I think we pull back in the short term. So I wouldn't trade it aggressively to the downside, but I would expect a push down there towards the 172, back towards these lows here, the gap area. I think that's likely. Another bearish idea, MetLife, you can see a level of support that stretches back quite some time. As that support level was built, you bounced on it on multiple occasions. You kind of squished into it. I've talked about this before, that I don't use support and resistance as though it's some rigid line. I don't use it like it's plywood and you can't even dip below. It's an area, and you see how we kind of dipped into this, and I don't care if it kind of squishes into support, but you can see the number of bounces and then the break, the hard break, and now we're coming up underneath. Really nice bearish candidate for more downside. And I suspect, again, I'm looking for bears because I've been positioned bullishly, so I'm much more inclined to enter into this one in the short term as opposed to waiting. And then Schwab, same thing. I look at this as something that's more ready to be actionable right here, right now. Support around 60. It's weak. It's kind of got that bouncing ball effect where it's big bounce, followed by smaller bounce, followed by smaller bounce, and down and through 60 seems likely in the weeks ahead. So really is kind of positioned for that in the here and now. So I'm looking for bears, and those are a couple of ideas that I think are more actionable in the very short term. On the buy side, I think we need more pullback. So you can tell I'm a little bit more excited to be adding some bears after, kind of today's advance and after this run that we've been on, which is a little bit of a change for me. Markets continue to advance, but I think it makes sense to kind of lighten up on the bullish side and get a little bit more. First time I've said this in a long time, but get a little bit more even on the bulls and bears both ways. Services PMI and manufacturing PMI come out tomorrow morning. And then there's still quite a few earnings. We've got American Express, Lumberjay, Twitter, and Verizon tomorrow to finish off the week. Please make note that next week it's large cap tech. Next week you've got Amazon, Google, Apple, Facebook. You've got large cap tech, all of them reporting at the same time. Historically, that's not so great for the markets when they do that, but I think next week is kind of potentially the finishing touch on this move. The way I kind of envision it is a little bit more upside here, but I'm looking for that big exclamation point. And if and when that happens, I may get net bearish. I'm still of the mindset that longer term, we're probably going to go back to the lows at least one more time and quite possibly pierce those lows. I think we're in a rough couple of years, for markets. Now, that's good for traders. That's bad for markets in general. We've got the Fed, it's shifted from quantitative easing to quantitative tightening. There's big changes that are taking place that take years to develop and years to play out and years to be priced into assets. And so I don't think the market's out of the woods yet. In the short term, it was overdue for this type of move. Longer term, I still think the market's going to experience a rough road ahead. So we'll leave it there. Thanks everyone for joining us. Have a great rest of your week, and we'll see you next time. Goodbye.